following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Brought to you by Zecco. Zecco is quite possibly the best value in online investing, offering a fully featured stock and options trading experience, spectacular customer service, and tons of free tools at pricing that is 30 to 50% less than the big guys. Keep in mind, options involve risk and are not suitable for all investors. Please read characteristics and risks of standardized options. For more information, including special offers, options education, and disclosures, visit Zecco.com/bootcamp. Now, let's start getting you into peak options trading shape. Here are your Options Bootcamp trainers, Mark Longo and Dan Passarelli.
Welcome to episode 2 of Options Bootcamp. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network. And I am joined here on the old options training ground by my co-drill instructor, the man with the whistle, one Dan Passarelli from MarketTaker.com. Dan, welcome back to the show.
Hey, Mark, it is great to be here. Fantastic show we have planned today for sure.
And I know you're fairly excited because today's topic in the basic training segment is one that is very near and dear to your heart. Of course, we teased it on episode 1, and today's topic is none other than the Greeks, those little variables that make all of the options world sing.
Yes, this is an important one and sometimes an overlooked one by novice traders, so I'm really, really excited to talk about this today.
And I joke about Dan's enthusiasm, but he is quite the fan of the Greeks, so much so, in fact, that he did write the book, quite literally, on the Greeks. So, Dan, why don't you remind our listeners about what your book is called, in case they want to go find it on Amazon after the show to read up more on this topic?
Yeah, certainly. My first book was called Trading Option Greeks, and it is designed to give basic, intermediate, and even advanced traders a really, really great understanding of the Greeks, what they are, how to use them, why to use them, and it's a really, really comprehensive book that I was really, really lucky to write, and I love sharing with people.
So we are going to synopsize that 10,000-page tome into a 130-minute segment or so. That's about it, right here today.
Exactly. The Cliff's Notes.
Exactly. The Cliff's Notes version of the Greeks.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, you're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, pull in, prepare to learn. Yes,
Well, listeners, you may be familiar with that term, the Greeks. Of course, we mentioned it on our previous episode, but what the Greeks are truly are the 4 variables. Some people will say 5. I really don't spend much time with row, but 4 variables that really define your risk parameters from an options perspective. They are in order of a lot of people's importance, at least particularly from the retail perspective: delta, gamma, Theta, and Vega. And Dan, since you are so excited to get going with this topic, perhaps I'll let you start off with the introductions for each of these and a little definition of what each of these variables means.
Sure. Let's start out with delta first. When you first learn options, probably what you learn is what a call is. and somebody tells you, hey, look, when you buy a call, if the stock goes up, you make money. Well, great. You're right. And it can. But how much money do you make? If the stock goes up $2, your call doesn't go up $2 probably. It goes up something other than $2, probably something less than $2. So you kind of need to measure that, because you need to, as a trader, have expectations for profits and losses. You can't just kind of wing it and say, oh, I think it's going up, let's buy a call. That can work out pretty lousy for a lot of people. So you need to get a little bit more scientific, and that's what Delta enables you to do. Delta, quite simply, is the measure of the sensitivity of an option's price given a change in the underlying. Now, it's stated in a percent. For example, if an option has, say, a 48 delta, that would show up in your option chain as 0.48. That means it changes in value 48% as much as the underlying stock. So if it's a call and the stock goes up $1, your call will go up 48 cents. So you might be able to infer already from what I'm saying is that this is a really useful tool. This takes away a lot of the guesswork, because I'll bet there's plenty of traders out there who have gone and bought maybe an out-of-the-money call and watched the stock go up $1 over a week or two, and they make 10 cents or 15 cents, and they say, geez, I thought I should have made a whole bunch more on this. What happened? Or in the negative case scenario, the stock goes down $1 and they lose 80 cents, and they say, oh, I didn't think I was going to lose that much. I thought I had limited, risk here. What's going on? Well, if you look at Delta, you eliminate that guesswork.
Yes, Delta is very much, for most beginning options traders, the primary Greek, I suppose you could say, the one they spend the most attention on. And Delta, you're right, it does give you that price sensitivity to the underlying. So if it moves, the underlying moves in $1, let's say, and the Delta is 50, you will lose, or you will make 50 cents on that trade. There also are some secondary, or I suppose you can call them ancillary definitions to Delta. One a lot of people like to use as well is that it also translates into the probability, rough probability of that your option will expire in the money. So if you have a 50 delta option, it's roughly 50-50, or a coin flip, whether your option will expire in the money. And as you start moving towards some of these lower delta options, these out of the money options, that probability, that delta drops dramatically to the point where your probability of actually having that call expire in the money is relatively low, which is why we tend to refer to those far, far out of the money options as lottery tickets. And we tend to laugh at all those customers who go out and buy them in droves.
Yeah, you know what? It's funny. One of the offerings that I have with Market Taker is one-on-one coaching. And one of the biggest challenges I have with a number of my students is to teach them to think in terms of probabilities. I mean, there's plenty of students out there who are, probably novice, and even some intermediate students who they'll go out and buy a call and they say, oh, yeah, I think I have about an 80% chance of this call working out, being in the money at expiration. But it's this out of the money call that has a 30 delta, and you look at it and say, where on God's green earth are you coming up with 80%? I'm glad you're confident and all, but it's not realistic. So it's a great tool to help people's minds kind of get into the habit of teaching in percentages, to use delta for exactly the purpose you're talking about. Hey, what is the likelihood of this option expiring in the money? Oh, well, the delta is 35, so there's about roughly a 35% chance.
I suppose we can save the hedge ratio for another episode down the road when we're getting into delta neutral trading and all of the fun aspects therein.
Yeah, for sure.
All right, Dan, so let's move on to the number 2 Greek, and I think for many newcomers to the options market, perhaps one of the most confusing Greeks, which is gamma. Gamma tends to relate back to delta, so people have a hard time sometimes wrapping their head around how that entire relationship works. So maybe, Dan, you could illuminate that for our listeners here.
Yeah, gamma can be kind of confusing to a lot of people, but in order to really understand it, there's one little nuance about delta that can make gamma really, really easy to understand. And that's how delta relates to what we call moneyness, or whether the option's in, at, or out of the money. In the money options have deltas greater than 50. Out of the money options have deltas less than 50. And at the money options have deltas that are right around 50. And you can kind of think about that a number of different ways. If an option's already in the money, that means it's kind of got a head start of being in the money at expiration, so it would have a greater than 50-50 chance of expiring the money because it's got that head start. An out of the money option is already out of the money, and the stock has to move a certain amount in order for it to become in the money at expiration. So it kind of starts at a disadvantage. It has less than a 50-50 chance of expiring in the money at expiration. That's just one little trick that I like to teach people in order to, kind of help them remember that. Okay, so knowing that, and obviously knowing that the underlying stock moves, it changes value, options are constantly becoming more in or out of the money. They have to. The stock moves, an option becomes more in or out of the money. So therefore, by definition, delta changes. Now, when there's a big move in the underlying, the delta can change a lot. And we've already talked about how important it is to know your delta. So when the underlying stock changes and your delta changes, you need to be able to track that. And that is what gamma does for you. Gamma is the rate of change of an option's delta given a change in the underlying stock. And it's stated in terms of deltas. So for example, if an option has a gamma of 0.10, that's a 10 delta, 10% delta. So therefore, if the stock goes up by $1, the calls delta will go up by 10. And if you think about that rationally, it's because the option is getting closer to being in the money or getting more in the money. Its delta must increase. And if the stock goes down, delta is getting more out of the money or less in the money, and its delta must fall, and it will fall by the amount of the gamma. If the gamma is 10, the delta will fall by 10.
So, gamma, it is that, that curious, that difficult beast, I think, for a lot of newcomers to the options market to wrap their heads around. That's why I want to touch on it here, but I don't think we'll go into it at too much length right now. There is a lot to be said on gamma. Of course, if listeners want to know more, they can always pick up your book and read about gamma at length, but we could easily fill multiple segments just with gamma. But I think we should move on to the next Greek, Theta, which is, I think, for most of our listeners, a far more impactful Greek, and also one that if they fail to learn its lessons, it will come back to haunt them at their peril in a much more stark and clear fashion than perhaps gamma. So, Dan, why don't you walk us through that most nefarious of Greeks, Theta, aka time decay?
Sure. Well, the deal is, as time passes, options lose value. And that's one thing that as a new trader, if you're just learning about time decay, which is what the phenomenon is referred to as, if you're just learning about time decay, you can remember this. Hey, I was watching this podcast, and this past rally guy said as time passes, options lose their value. Sure, you can remember that, and you can just trust me. But let me kind of help you understand the logic of it. Options have value because of the potential for future volatility. Let me phrase it to you this way. If you were to buy a 50 strike call, that gives you the right to buy the stock at $50, right? So the question is, would you rather own that right for 1 day or for 1 year? Well, you'd rather own the option, all things held constant, for a longer period of time because there's more time for volatility to play out and make you a profit. If you could buy a 1 day option or a 1 year option for the same price, that's a no-brainer, man. You would buy the 1 year option. There's greater potential for something good to happen. So logically, longer term options must be more expensive than shorter term options. They have to be. They're in greater demand. So therefore, we can kind of postulate that statement a little bit as well and say, as time passes, options must get worth less. And indeed they do. Now, just like delta is very useful in helping traders come up with reasonable expectations and measure expectations, theta does the same thing, but it does it for time. Theta is the rate of change of an option's value given a change in the number of days until expiration. Theta is stated in dollars and cents, in option premium dollars and cents. So maybe there's a call you're thinking about buying for $2.50, and you look in your option chain, you go across the screen, and you see that theta is 0.05. That's 5 cents of theta, of daily theta. So that means as each day passes, that option gets worth less 5 cents. If no other factors affect the value of the option, for example, the stock doesn't go up or down, it stays exactly where it is, volatility doesn't change, interest doesn't change, that kind of thing, the call would go from $2.50 today to being worth $2.45 tomorrow to being worth $2.40 the next day, and so on and so on. No, that's not reality. Stock prices don't stay glued to a certain price. Traders might make money on delta or lose money on delta, but the option still gets worth less each day by the amount of the theta.
You know, theta, like I said, is a very interesting Greek, as I alluded to earlier. Depending on your trading style and your trading strategy, theta is either your best friend or your worst enemy. If you're a primarily long options trader, and by long, like I said in the first episode, I'll clarify that again. When we use these phrases like long premium, we don't mean that you're bullish. We mean that you're buying, you own, you're purchasing options contracts. And so if you are primarily buying options, then theta will be your worst enemy by far. Theta will be the beast, the enemy you have to overcome with every one of your positions. You have to make sure that your prediction on the underlying, your delta, essentially overcomes your theta before the theta catches up to you. And on the flip side, on the dark side, depending on your point of view, many professional options traders tend to love theta. They tend to embrace theta and that characteristic of options losing a little bit of their value every day by selling options. And that is a topic we will get to in a later episode, where you can collect decay and generate income and generate even a dividend yield from selling options on a particular underlying. And it's a very attractive style of trading for a certain population of the options audience. It's also a very risky and sometimes leads to a lot of sleepless nights. I know, Dan, when back on the trading floor, you could always tell going into expiration who were the long premium traders and who were the short premium traders, because the guys who were short premium were sweating profusely and popping Tums like they were candy. So you could just walk through the floor and spot them. Bam, 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 there you go. So there are certain trade-offs to being a short premium theta collecting, income collecting trader, and that may be some sleepless nights in your near future.
Oh yeah, there sure was. I remember those well.
Yes, and so we will definitely get into some of the vagaries of selling options and collecting decay on a later episode, because that is very much a popular trading style. But since we're talking about the Greeks here today, let's wrap it up with, in many ways, particularly for the professionals out there, the king of the Greeks. And yet I use that term loosely because for the target audience of this program, the newcomer, the novice options trader, it is probably more like the prince or perhaps the archduke of Greeks, because it isn't exactly as well known. Of course, I'm talking about volatility, or Vega. And Dan, why don't you give our listeners a rundown on this most regal of Greeks?
Indeed. Vega can be the tricky one, because everybody understands time and everybody understands that stock prices go up or down, but a lot of people don't fully appreciate the volatility aspect that's embedded in an options price. It's called implied volatility. And it kind of works like this. There are plenty of traders out there who buy and sell options only because they are hedgers. And it's not like, oh yeah, there's these 3 guys who trade one lots who, use options for hedging. There are these thousands of people who are professional traders who manage billions of dollars who go out there and buy puts when they fear future volatility. Or they sell calls when they're pretty complacent. They think the market's not really going to move around too much. And they push around option prices with supply and demand, just like high school economics 101. So even if the stock doesn't move, and even if time doesn't pass, your option prices can go up or down based on traders effectively trading on expectations of future volatility. So when the market collectively expects volatility to rise, option prices go up. It's called a rise in implied volatility. When the market collectively expects volatility to fall, traders tend to sell options. They sell out the hedges that they had and maybe even sell some calls to generate some income on investments. So that forces option prices lower, and that means implied volatility is going lower. So, just like you need a way to measure the effect of direction on an option, and just like you need a way to measure the effect of time on an option, you need a way to measure the effect of implied volatility changing on an option, and that, ladies and gentlemen, is called Vega. Vega is the rate of change of an option's value given a change in implied volatility. If implied volatility goes up a point, your option goes up by the amount of the Vega. For example, if the Vega is 0.06. If implied volatility goes up 1 point, the option goes up by 6 cents. If implied volatility goes down 1 point, the option goes down by 6 cents. So on the one hand, Mark, like you were saying, yeah, professionals live and breathe this stuff. I mean, Vega can be the most important thing that you're trading if you're a pro. But people who are not professionals can benefit from it as well. Because the fact of the matter is, if you buy or sell an option or an option spread or any option position, guess what? You've got a position in implied volatility. Whether you know it, whether you want it, whether you like it, you're trading implied volatility. You will make or lose some money. It is one component that affects your profit or loss. You will make or lose some money based on implied volatility changing. So therefore, you better be looking at Vega as well.
That's one of the reasons why I tend to use the terms that I do there for Vega, because obviously it is important for retail traders to be cognizant of what they're trading and what they're doing, and that, in fact, they do have volatility positions. The vast majority of them simply are unaware of that fact, and that's why I tend to think of Vega as a very much the professional's Greek, because if you talk to most professional options traders, former market makers like ourselves or institutional traders or hedge fund managers, whatever the case may be, the vast majority of them will tell you, I'm not an options trader, I'm a volatility trader. They simply look at the market, they trade options from a different perspective. And Dan, I'll be curious to hear your input on this, because we receive this question all the time at theoptionsinsider.com. What is the most significant difference between a professional options trader and a retail options trader? And I tend to break it down like this. I tend to say, just using the shorthand of the Greeks, the professionals trade Vega and the retail trades Delta. Would you agree with that very general characterization?
Yeah, I would say the professional trades Vega and the retail trader trades Delta or Theta. Now, or both. Now, to be fair, both are trading all of it. But it's a matter of perspective. It's a matter of what you focus on and what you're setting out to trade and intending to trade. And I actually talk a lot about this in my second book, The Market Taker's Edge. I have basically a whole chapter devoted to this. It's on what I call the symbiotic relationship of the makers and the takers. And basically, market makers and other professionals, because they're trading volatility, and what we call retail traders, or what I call stay-at-home traders, are trading not really volatility, but time and direction. When a non-professional sends an order to the exchange and trades with a market maker, maybe the retail trader buys a call and the market maker therefore sells a call, they can actually both make money or both lose money. A lot of retail traders think, I can't compete with those market makers. Well, you're not competing with those market makers. In fact, they actually help you. It is truly a symbiotic relationship. And it's because, hey, all they want to do is make the trade by buying the bid or the offer and put on a volatility trade by trading delta neutral and take it off and make a couple of pennies and do that on thousands of contracts. You are going in there and buying a call and hoping to sell it for 50% higher a little later, or selling an iron condor and hoping to, reap 80% of your maximum profit 3 weeks later. You're doing something completely, totally different, and you guys can both be winners or both be losers.
Yes, they love that customer order flow coming in and hitting their bids and lifting their offers. It makes their day, and it's far too infrequent for them these days, which is why they love when the customers come in and do that. And you're right. It drives me crazy whenever I hear options described as a zero-sum game, because in the strictest technical definition, they are, of course, but that completely ignores the hedging phenomenon, which changes the game entirely. And the way market makers hedge versus the way retail hedge, or in most cases don't hedge, means they can you're right, have exactly the same position on two different sides of the same position and both make money. You and I, Dan, when we were trained as market makers, we were trained to essentially ignore delta. We were trained to trade that style of delta neutral, where we would hedge with the underlying and eliminate delta essentially, or reduce as much as we could from our positions, so we could trade that quote-unquote pure volatility. And that is what we were trying to get at. Whereas retail, they are coming in looking to maximize their delta, or in many cases collect or pay theta, depending on their position, and trade in that sense. So there's a very different perspective on how they trade. Of course, that is a topic for another day. And of course, Dan, we have barely scratched the surface of the Greeks here today. There's so much more that we could get into, perhaps on future shows and future episodes. Things like how the Greeks change depending on your frame of reference, and how as your time to expiration changes or your volatility changes, how other things like delta and gamma and theta change accordingly, and how the Greeks interact with each other. And there's so much more there, so much nuance of how the Greeks actually perform in the real world that we hopefully can get to on another show, because we just don't have time in this episode. But we wanted to be sure to give our listeners at least this basic overview, this basic outline of the four primary Greeks: delta, gamma, theta, and Vega. I say there is another one. There's that little interest rate Greek floating around out there. Not exactly too relevant in this day and age. May come back again to play someday, but right now we don't really pay too much attention to him. But this is hopefully an overview for you out there who are coming to options for the first time and have heard about these Greeks and have been terrified by this terminology, and perhaps this could put it in a little bit more relatable perspective for you. Dan, do you have any closing thoughts on the Greeks for our listeners here?
Yeah, no, like you said, Mark, this was a great overview, and I hope this was a fantastic introduction to many of you. But boy, oh boy, we can have probably 1,000 more shows on different nuances of the Greeks.
Yes, there's a lot to get to, particularly how they perform as the market changes and conditions change, and how that in turn impacts your positions. That is probably the number one thing to learn once you master the basics of the Greeks. But that is indeed for another day and for another show. And now, Dan, we're going to close out this basic training segment. So by all means, put away that whistle. I saw you walking down the street wearing it the other day, and it seemed a little out of place. So save it just for the show, please, and the hat as well. And now
what about the Ray-Bans?
Well, you can keep those. I prefer the aviators, but whatever your preference is, sir. And now we're going to dive right into our roll call segment.
Roll call! You boots listen up while today's guest speakers are announced.
And welcome to Roll Call. This is, of course, the portion of the show where Dan and I bring on some guests. And today's guest / victim is none other than John Foley. John, welcome to the program.
Thanks for having me on, Mark.
Yeah, I'm glad we could do it.
I'm really glad to be coming to this segment of the show because I have been trading options for many years. As an options trader, our compliance department would want me to talk about the risks of options, and I don't have to go very far to do that because I was doing my taxes last week and noticed that of the 5 option trades I made last year, 4 of them did not make money. So I need
very
help.
Easy from an accounting perspective.
Yeah, really. And I understand. I've heard of the Greeks, of course. I've seen them. I don't know that much about them, and I really I'm looking forward to learning a little bit more about them from the show here, and talking about how they are visible in Zecco's trading platform, and also how our customers might use them to help be better option traders and help have more wins and fewer losses.
Well, why don't we start there then? Let's help point some of our listeners in the right direction. Dan and I obviously just had a very lengthy, and if I may say so myself, extremely entertaining conversation about the Greeks. And now a lot of our listeners, I'm sure, are coming to this. Many of them are newcomers to the options space and newcomers perhaps to Zecco, and they're probably asking themselves, well, you just went through all this detailed information about Delta, Gamma, Theta, and Vega. Where can I find that on the old Zecco platform? So, John, maybe you could walk us through that, or walk our listeners through that, so they can have a better perspective on where they could find this information just to get started with it.
Well, there are 2 places. When you place an option trade on Zecco, you have the option or the choice of looking at the entire option chain. And just by clicking that, you would enter the ticker symbol of whatever your underlying security is and click on view the option chain, and you'll see all of the open option series for that. And you can narrow it down by month or whatever. But the default view of that is going to show you pricing, but you can click a button to show you the Greeks. So that, for instance, if you are looking to take a speculative position, buying a long call on a stock that you think is going to go up, you can look at the Greeks viewpoint of this and decide which of these different statistics, by looking at the statistics, which particular option series you want to buy. So again, a question for me there is to you guys, in the scenario that I just talked about, I did a trade last year where a stock had gotten way too expensive and I wanted to take a position in it. So I decided I wanted to buy a call, and I ended up buying too short a series. I ended up buying the next month's strike price out, and the stock ultimately did move, but it didn't move within my time frame, and I ended up losing money on that. How might I have used the Greeks to not make that same mistake?
Yeah, you know what, John? That's it's a very common mistake, and the thing is, I guess they must call options for a reason, because boy, oh boy, you got a whole lot of choices on how to trade. Even a simple bullish forecast. You got to consider time, you got to consider how big of a move, and you got to consider volatility. So you have to look at your Delta, your Theta, and your Vega. When you are bullish on a particular option, when you're bullish on a particular underlying and you buy a call, the one thing you definitely need to do, even before looking at the Greeks, just kind of big picture, is make sure you're giving yourself enough time. And just think, hey, look, if I'm looking for a bullish move in this stock, how long do I think it's going to take? And on the one hand, I'm probably not telling anybody anything new. I'm just telling you something maybe you haven't thought of before. You probably already kind of subconsciously do this. Like, okay, I'm bullish. Am I looking for this to rise over the next 5 minutes or over the next 5 years, right? Those are extremes. Kind of fine tune a little bit, and fine tune around option expirations. Hey, the Aprils expire in 29 days or what have you. do I think that the move is going to happen before or after April expiration? If it's after, you got to use a longer term option. And you don't know how long the move is going to take. It's called forecasting for a reason. So, you just kind of have to use the art and the science, if you will, in selecting the most appropriate time horizon.
Yeah, John, the Greeks tend to play in for strike selection a lot more than maybe expiration month selection for a lot of reasons, particularly the Greeks that retail tend to focus on, which is primarily Delta, and then to a lesser degree Theta, and then to a much lesser degree Vega. We see a lot of retail traders coming in and making the mistake of looking at, let's say, XYZ stock and saying they're bullish and they have a bullish perspective on this. And then instead of perhaps picking up a at the money or maybe even an in the money option that will have a significant amount of bang for the buck, a significant amount of the Greeks, a very high delta, 50 or above, and will be a much better bang for their buck type of scenario, but also a more expensive scenario, they will tend to migrate to the lower delta, the lower probability, the more out of the money type options because they are dramatically cheaper and focus their liquidity there. And so that's a typical mistake we see from first time or new, I should say, novice retail options traders, that they tend to migrate their liquidity to the lower delta options and therefore the cheaper options when perhaps they should really be focusing closer to at the money or perhaps even in the money to get much more bang for their proverbial buck. And from a time horizon, that really is a bit of a toss up there as to what your own personal forecast is. There is no one metric to say, well, you should really look at this particular Greek in order to determine which month to buy. If you're trading volatility, then there certainly is a way to do it. If you're looking at Vega, then of course you can look at the term structure of the option and then pick your strikes or pick your months accordingly based on whether you think the term structure is too cheap or too expensive. But that is a relatively advanced level of trading for the audience of this program and for the newcoming options trader. So we typically tend to focus on delta and its impact on strike selection. And the most prominent impact we see over time is people migrating to the lower delta, lower probability, cheaper options precisely because they are cheap and ignoring all of the other metrics that perhaps would lead them to a much more suitable and more profitable strike selection.
Again, what I hear you saying is, if I'm hearing you correctly, is that one way to reduce your risk, and you don't eliminate risk, but one way to reduce it is by going with a deeper in the money option and therefore a higher delta.
I think it depends on what you mean by risk. You will obviously be putting more premium on the table, but also those options will have more meat, more intrinsic value. They will suffer less from time decay. As we discussed earlier in the basic training segment, options that are out of the money options suffer quite a bit from theta or time decay, and they could lose their entire value from time decay. And in the money option will have some what we call intrinsic value, inherent value to that option that is immune, shall we say, to time decay. A smaller percentage of that option is going to be exposed to the vagaries or the whims of theta, which is nice from a long position. If you're looking to hold that position over time, that makes it easier to manage. Of course, if you're trading at the money, you still have some problems with time decay, but you can mitigate your theta risk and your time decay risk, which is one of the most significant risks for long premium, long options traders, by looking at and taking a very close look at your strike selection and the delta of those options. Would you agree there, Dan?
And, Mark, let me just kind of add to what you started talking about here and point out something kind of interesting. You said, hey, look, what we should really kind of focus on is delta, especially if we're trying to keep things basic and simple, which I agree with. But there's kind of like the proof in the pudding case and point, proof positive that you really can't talk about one Greek without talking about the other ones. Even if you try, you can't,
Yes, and I was trying very hard.
Because, even though you're talking about delta, which is perfectly rational, the word time decay crept up there several times because it has to. Because time decay is always a factor when you're buying a call. And it's kind of interesting, you kind of pointed out one of the nuances that long or in the money calls rather have, in addition to just having a bigger delta, they have a lower theta, which provides some benefits, and in one context of the word, I guess, minimizes your risk somewhat.
And John, you made an interesting point there about how people can find that on the Zecco platform. I thought that was interesting Tony mentioned on our first episode, and you just brought it up again, that the platform also shows you where the Greeks for a position you plan to put on. Let's say you're going to put on a time spread or a vertical spread. You can look at the Greeks ahead of time. And so so that is something I think that is very interesting. Let's just run through that again really quick. If someone puts in a spread on the Zecco platform, it will automatically show the Greeks for them right there, or do they have to click on a few tabs in order to really find the Greeks for that position, or is it all showed right alongside the bid and offer for that particular spread?
There is a button they can click to see that. You have multiple possible views. I think most people would regularly work in the prices one because, as I think Dan said, the instinct here, particularly when you're buying a long call, is I want to get the most bang for my buck, which, of course, is the riskiest thing to do. I'm buying a far out of the money because it's cheap rather than necessarily pushing the Greeks button that might help me make a more informed decision and maybe a less risky one that might ultimately be more likely to succeed.
All right. Thank you for that, John, and thank you for that customer viewpoint, I suppose you can call it there. I know you've been interacting a lot with the options customers over there at Zecco, and it's nice to see what you guys have going on over there. And before we close out this roll call segment, is there anything else you think would be interesting for our listeners?
Well, another view of the Greeks in here is when you look at your positions on the position screen, if you have any option positions, there's a pull down and you can select the view option data, which will then show you the Greeks for your position. And it might be interesting to find out, if if I hold a position, how I might use that to help decide the timing of when I should close out that position.
Listeners may wonder why we belabor this point so much about how you can find the Greeks in the platform and how you can utilize that. But, from Dan and I's perspective, this is a relatively remarkable thing that so many retail customers now have access to these types of tools essentially for free for the price of the commissions that they're executing on the platform. If you look back to when Dan and I were on the trading floor, it was literally you could only check your Greeks on an infrequent basis throughout the day. And this is a professional trading operation. You'd had to have your clerks run it through a special computer, which took a significant amount of time, and then bring out a printout or a run to you so you could see how your position was looking at that time. And it was usually dated because it was several minutes old, at least at that point. And It was something you got maybe every couple of hours if you were lucky. And the notion now that even the most basic novice retail customer can come onto a platform such as Zecco's and see the Greeks of their positions, of positions they want to put on with a click of a button, that is, to me, still a remarkable thing, even in 2012.
Yeah, it sure is. It's incredible. I mean, geez Louise, it is a great time to be a retail trader.
And the best part is, Dan, you and I aren't that old, so we've seen a lot of change in this short amount of time that we've been floating around this options space here.
Hey guys, my first job in the brokerage business, you wrote paper tickets and you gave it to a wire operator. Literally. So I've been doing this for a long time, but I get your point. I mean, right now, so much data is available to us, and this enormous amount of computing power. The thing that is a little bit lagging is the education. I mean, we give people these very powerful tools, but okay, so how do I use that? How do I leverage that to make more money for myself? And I mean, here, again, back to my question. So I've got an option position. Mm-hmm. For me, at least, where I make a lot of my mistakes is either hanging on too long or getting out too soon. How would the Greeks help me inform that decision and pick the right time to move out of an option?
Yeah, well, one interesting nuance of options, and Mark just got done saying one of the big mistakes is people buy the out of the money options, and at the money or maybe in the money option might be better. With at the money options, as time passes and the option gets closer to expiration, the theta, which is the measure of time decay, increases. So the idea is when you get close to expiration, options start losing value really, really fast. So when you own a call, you really want to get out as soon as possible, because every day that passes hurts you just a little bit. Even if you're making money on Delta, you're definitely losing money on Theta. So, you can't hold on too long, especially knowing that Theta is going to increase, and it's not just going to hurt you every day, it's going to hurt you more and more every day.
We mentioned on one of our other shows here on the network, one of our other hosts has a favorite saying of his that options die a little every day. And it is totally true. And as scary as it sounds, it is completely true. And so you're right. Whenever you are trading long premium and you're trading long options positions, then that is certainly a consideration you have to make, lest the Theta overwhelm any directional or delta move that you have in your favor. And so, people have different parameters that they set for themselves and how they can incorporate those Greeks to maybe close out positions at the right time. Some people will say, well, if this long options position, let's say, decays and the delta drops to 25 and I picked it up when the delta was 50, okay, that's when I'm going to close this position out. You can look at the Theta. There's a lot of different ways people use the Greeks, I think, as some sort of bellwether or parameter to say when to close out X options position. I think Delta, for a lot of retail traders, is a good way to do that. If the position is really going against you, your Delta is getting very small, your probability of that trade paying off is getting very small, then it probably is time to maybe close it out and either roll it to another position or just try again. A lot of people will tend to, particularly newcomers to options, when they're buying options, that's very much an all or nothing prospect to them. They will buy the option and they will cling to it for dear life, regardless of what is happening in the underlying or the market. And they, even if it's going against them, a lot of times with a stock, if the stock is dropping, you will sell it out and cut your losses at a certain point. But with options, for whatever reason, with retail particularly, they will cling to those long options positions until they erode to zero. And that's something that I like to get out there every now and then, that, you can close out these positions and mitigate your losses. And perhaps Delta is a good way to do that. If the Delta of your position drops below a perceived threshold that you've set, perhaps 30, perhaps 40, perhaps 20, whatever the case may be, then it probably is time to perhaps close that out and move to a much more favorable position. Take your hit.
Yeah, I think a lot of it has to do with kind of self-awareness, knowing who you are as a trader, and specifically knowing whether you're a trader or an investor. A lot of people get into trading having first been an investor, and boy, oh boy, that's a completely different thing. I mean, an investor looks for value in a stock and will buy and hold the stock. And when you get that ingrained in your mind, buy and hold, if I just hold it, it's going to go up because this money manager told me once that stocks are supposed to make 8% a year. So if I just hold it, I'm going to make money. When you have that mindset as a trader, it could be a disaster, especially as an option trader. So you need to have a plan when you first start out. I am going to hold this. I'm going to take my profits at X percent. I'm going to take my losses at X percent. Or like you were saying, Mark, you can base it off Delta as well. Hey, if my Delta gets down to 30, I'm out. My Delta gets up to 80, I'm going to lock in my profits. But, investor, trader, two different things.
Well, and one thing that you can do on our platform to help you do that is place conditional orders, so that if I have a one canceled others order, I have an option position, I can say set a stop order. Let's say it's currently at 4. I can set a stop order to stop me out if it goes down to 3, and I can also set a limit order to take my profits if it goes up to 6. And whichever one of those two events occurs first, the trade will get executed, or may get executed if the conditions are right, and the other order would be canceled. So there are tools in the platform that help you do exactly what you're just describing without having to sit there at your terminal every day and never move to get up and get a cup of coffee.
Now, John, one of the things I think a lot of brokers are starting to adapt to now, and this gets back to your question of how do you use the Greeks. For practical purposes, I just mentioned, using Delta as perhaps a surrogate for your stop loss. But still to this day, most brokerage platforms won't allow you to place a contingent order based on the Delta of your position. I'm assuming Zecco is in that same camp. You can't go in and work a stop loss that says if my Delta gets to 30, stop this position out. That's not the case, correct?
That is correct. I don't think, as sophisticated as all of these systems have become, I do not know of a system that can do that yet.
Yes, that's still a little bit down the road for most firms.
Again, that was one of the questions that I've asked our development guys, and I think it would be a great feature if that is a possible thing to do.
That's one of the reasons why I hesitate to come out right away and say use Delta or use some of the Greeks as your ways to gauge when to get out of your position, because it's difficult to execute off of that. You then have to take that delta of 30 and translate that back into some price, and then you're kind of going back off price again. So it's easier for the beginning retail guy to queue off price and then go from there, because he can execute conditional orders on price. Whereas the Greeks are coming, it's a very difficult process to implement that effectively and have the right Greeks calculation and then queue off that for trading. But I know that's something that's coming down the road, so we'll have to look forward to that in some upcoming revisions of the platform. And speaking of looking forward, John, I appreciate you joining us today. I feel bad, actually. We brought you on to talk to you, and you turned the tables on us with all of your questions. But that was a fantastic thing. And maybe that's a good way we can bring you back onto the show down the road. I know going forward, we plan to have a lot of interaction with the Zecco community and a lot of questions from them. And perhaps you could be our point man, our go-between for those questions and bringing us that customer viewpoint here onto the show.
I would really love to do that.
Well, John, thank you very much for joining us, and that is going to do it for our roll call segment. That's also going to do it for this episode of Options Bootcamp. I, of course, want to thank John Foley for joining us on the program today, and we hope to have him back down the road in future episodes where he can bring us some more of that Zecco customer perspective, and we could build that into the show going forward. I also want to thank, of course, my co-host, my fellow drill instructor, good old Dan Passarelli from MarketTaker.com. Dan, I'm so glad we could have you on the show, particularly for today, because the Greeks are very much your baby.
Yeah, thanks, Mark, and thank you. This was a really, really great show, near and dear to my heart, and look forward to doing some more of these.
Yeah, I look forward to perhaps investigating some of those nuances of the Greeks we alluded to in our basic training segment, and perhaps how they could impact our various listeners and their positions going forward.
For sure.
And, of course, Dan and I want to thank all of you out there for downloading and streaming and subscribing to Options Bootcamp. And we're looking forward to seeing you right here for Episode 3.
This episode of Options Bootcamp was brought to you by Zecco, quite possibly the best value in stock and options trading. If you'd like to submit a question for the hosts, visit facebook.com/Zecco and post it on the Zecco fan page. Zecco reminds you that options involve risk and are not suitable for all investors. Please read characteristics and risks of standardized options at Zecco.com/ODD. Multiple leg option strategies involve additional risks and multiple commissions and may result in complex tax treatments. Please refer to the spread trading disclosure found in the options agreement and disclosure document at Zecco.com/disclosures. The Greeks represent the consensus of the marketplace as to how the option will react to changes in certain variables associated with the pricing of an option contract. There is no guarantee that these forecasts will be correct. Technical and other supporting data on this program can be supplied upon request by contacting editor@Zecco.com. Electronic trading has inherent risks due to system response and access times that vary due to market conditions, system performance, and other factors. Options Bootcamp is produced by the Options Insider Incorporated in association with Zecco Holdings Incorporated. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.